Hey guys, welcome to the second episode of the 0 to 100k challenge. The series where I invest everything I make here on YouTube and see whether I can build another 100k portfolio. It's been an interesting month, that's for sure. We've had tech stocks crashing hard and an all-round dip in the market with the brink of what people are calling World War III. The results of which have been somewhat mixed, but in my opinion, it's created a nice buying opportunity. For those of you who didn't catch the first episode, as I know we've got a lot of new subscribers, which is super nice, and for those of you who press that like button, because I do really appreciate it. To get started, here's a quick recap of the rules and a bit of clarification. This series is me building an investing portfolio starting from zero. Last year I started this YouTube channel. It's not my main business income, just what I've made in my spare time. It's kind of just my side hustle. The point is to show you in the most transparent way possible what building a portfolio takes, the ups, the downs, and everything in between. There will be losses along the way as well as nice wins, but that's okay. I'm not claiming to be some forex day trader turning 0 into 10k in a week. It's just an honest, realistic approach to investing. With each of these companies I'm looking at a minimum of a 3-year outlook, unless something changes. This portfolio is looking likely, and if it's converted into a SIP, will be invested for a minimum of 24 years. I've been asked quite a lot about the frequency of these videos, and the answer is really, it depends. It depends how much I'm able to make from YouTube, as I think I do need a substantial amount to make each episode good enough. If things like sponsors and Patreon members grow, it will allow me to make these more frequently. I also do need to make content that's evergreen, meaning it has a chance to make recurring income, as these are more of a one-off style videos, because they're not always as relevant once the time has passed. If you do want to stay more up to date with this, I update regularly over on my Patreon, as well as let you guys the exact moment I buy and sell these stocks. So do consider checking that out. I'll leave a link down below. Last episode, I invested £3,000. I bought Airbnb and On the Beach to get exposure to the travel industry. I bought Gear for Music and Focusrite in the musical equipment industry, Cooper in the software industry, and McFarlane in packaging. Last month we managed to outperform the market, which was nice, although that's not my overall goal in the short term. Technically, you don't need to outperform the market every single year. You could miss it for 3 years and then have 1 year where you do 60%, and that could completely change your portfolio. So while it's nice to beat the market, it's not my primary focus. All of these companies I think remain good buys. I'll update you on which ones I bought more of and which companies I've added to the portfolio. But first, I have to say a huge thank you to today's sponsor, CoinJar. CoinJar have launched the UK's first crypto to pound credit card alongside MasterCard. Here's the card that I received in the post yesterday. You can see it is super sexy. And the card allows you to make purchases by converting cryptocurrency to cash. It all works alongside the flat 1% fee that CoinJar charges. You get that 1% back in CoinJar points, which can be used on transactions and used in their store to buy rewards like vouchers and software subscriptions, and their UK store will be launching soon. If you haven't already, make sure you grab yours. It's free to download. Just download the app and click order your card. So let's talk about what I actually made in January. January ended up being a really nice month. YouTube ad revenue came in at 327, which was slightly down from December, which is actually quite interesting because a lot of people say this is the most lucrative time for the year, but I actually think that doesn't matter too much, and it's more to do with how many views you get. February is looking more promising thanks to my Investing for Beginners video doing well this month, which I'm super grateful for. Affiliates did really well this month at 1,086. This is mostly because one provider I use has an annual subscription, which has landed around now. This is a total of all of my affiliates or links in the description, which will pay me a small cut per sign up. Hopefully this will only continue to grow as the channel does, but I'm super happy with that. Sponsors came in at 2,126, which was very nice. And a lot of this is due to one block sponsor deal, so I won't be getting this every month. I'm hoping I can maintain this over 1,000, but this will likely dip over the coming months. Hopefully, once the channel continues to grow, I'll be able to attract more sponsorships to keep that going. And it's also a bit of a learning curve, and with me being super selective over sponsors, it may be limited at times. I'm working on finding a handful of sponsors that I really like, rather than just selecting anyone. Lastly, we have Patreon, which is coming at 195, which I'm super appreciative of. We've got over 65 members now, which is super cool, and it's so nice to interact with you guys on a daily basis. Hopefully that will continue to grow throughout the year, so I can be less reliant on things like sponsors and ad revenue. In total, January was 3,735, which is amazing. I don't expect this every month, but it has been very nice. This brings the total earned so far up to 9,903 over 12 months, averaging around £825 per month and £20.64 per hour. We'll have to keep some of that money back for tax. I'm currently keeping 20%, which is £1,874, which we may be able to invest shortly, leaving £8,034 to invest. For episode 3, I'll have £2,000 to invest, possibly more depending on the tax situation. Investing less may allow me to make these a bit more frequently. I'm also cautious, of course. I don't really want to be making a 50 episode series to 100k, so we'll just see how that goes. So that's the income for the month. Now on to what I bought last month. First up, I bought my first ETF in the portfolio, which is HRUB. This is a Russian ETF I've held before and I did pretty well with it. Russian stocks are at a 14-month low due to the Ukraine-Russia conflict, which once resolved, I don't think it's going to be short term, but I can see things recovering. Oil is up significantly with very high prices. 46% of the ETF's holdings are in non-renewable energy. I know it's not the future, but we're still very dependent on it. It has a respectable dividend yield of 4.9%, which could be very nice on top of the recovery. I like to pick stocks where I think they have been punished because of a timely event, with an outlook of recovery in the future. I bought £500 in my growth portfolio, followed by another £500 and another £250 when it was down even more. This is a strategy I like to adopt and what tends to get me the biggest returns. I pick a stock that I think is undervalued, and if it drops more, I'll buy more of the company. Next up, on a less war-ridden note, I bought shares in Vodafone. Vodafone shares have had a really nice start to the year. They're up 8% based on rumours of a merger with Three. This would add 9.3 million customers to its existing 20 million customer base. If the merger goes through, it should give a nice boost to the stock price, and its impressive scale makes it an efficient operator. It has high quality networks with 5G capabilities, meaning it can compete on quality and not just the price. The shares currently have a hefty 7% dividend yield, which is really nice on top of the share price. Genuine Impact rates Vodafone highly, 7 out of 13 in the top 20%, with strong signals on value and dividend strength and stability. It has had a really nice start to the year, but it's still way down on its historical prices. If we see return to even half of 2016 levels, it could be a 50% gain on the price. I've invested £500 into this company. It's quite a boring pick, but I think it's cheap for where the company is and could see some nice growth. Boring actually seems like quite a nice approach in the current market. I've also added £100 into my Airbnb, which was my remaining balance, to help average out my position as it was my worst performer at the time. This may likely form part of my strategy too. Probably each month I'm going to be averaging into a couple of the worst performers, unless there's a reason not to. I then added another share to my portfolio, which is Alphabet, or Google as you might be more familiar with. Now traditionally I've been buying more UK based companies, but as the portfolio grows and it's a growth portfolio, I need to increase my exposure to the USA, but that will be gradually and I'll be cherry picking, as it is unbelievably high. They are the dominant player in online search advertising thanks to its billions of loyal users and technology. I think they've really cemented themselves with Google and YouTube, and I can't see them being replaced. They're benefiting from tailwinds, driving more advertising and commercial activity of all sorts online. A cash-heavy balance sheet provides plenty of firepower to reinvest in developing new services, catching up to the leaders in the public cloud arena, and buying back lots of its own shares. It's trading at 47% below its estimate of fair value. Their earnings are forecast to grow 11.23% per year. Their earnings grew over 88% over the last year. Google is actually rated extremely well on Genuine Impact. It's in the top 20% for 6 out of its 13 categories, and that's on things like quality, momentum, and accounting strength, with the remaining all in the middle category and 0 in the bottom 20%. Now this one may dip in the short term if a major crash happens, but my plan is to buy consistently and average out across the board. I also do like Google as a company. As much as they control everything on the internet, they are very clever. I've also bought £500 worth of Smithson, SSON. Now Smithson is another ETF I'm adding to this portfolio. It's one I bought in my lifetime ISA and it is a long-term hold for me, but it's down 25%, which to me represents a good opportunity. There's a really nice summary of the fund here. I'll leave a link down below. The fund essentially invests in small to mid-cap companies, 500 million to 15 billion. It's run by Terry Smith, who is a very nice fund manager, and his team. Fundsmith is his other fund, and I'll likely be picking up some of that soon too. Some of its more recognisable holdings include Fevertree, Rightmove and Domino's. It's down 15% year to date, but it's been up 18 to 33% over the past 3 years, and that's per year. This one is a very nice long-term hold and something I'll definitely be picking up in my main portfolio too. On Genuine Impact, its net assets and liquidity are in the top 20% category, with return and fees in neutral. It does fail on stability, net asset change and year-to-date performance, mostly due to its performance so far this year. I then finished off my buys with a top-up of £200 in Cooper. Cooper is a company I bought before. It's essentially one of the worst hit companies in my portfolio, so I'm happy to average into that. I've then added £250 into On the Beach, OTB, plus 17% on this company so far, and I think this one still has a good way to go recovery-wise. I can see the UK travel sector making a nice recovery over the next few years, and it seems the worst of coronavirus is now behind us, as we see things like all restrictions being lifted. I may consider consolidating my positions in Gear for Music and Focusrite into one holding, as they're both very similar, but they're both really strong companies that I would buy more of. A really neat feature of Genuine Impact actually allows me to compare two companies on metrics like quality and value and expected return, which is really handy to see. So I'll definitely be using this tool when I consider my options. So here's all my holdings, and you can see my top down to my lowest holding and how much I've invested. And I've also added which section this covers. So we've got Russia, travel, phone and tech, mid-cap, etc. So you can see how I'm doing so far. Russia's been down slightly, no surprise, because of the whole situation. I received a dividend of them in my main portfolio, which was super nice. I think it was around £188. But they still have a massive potential upside. On the Beach, I've done okay with them. I'm plus 12%. Airbnb's also up 1%. Vodafone's up 8.6, which is really nice. Now these two are mostly down just because of the fees when I bought the funds, and I've only literally bought them this week. And you'll see some of my other positions are down. So McFarlane are down 10%, Cooper's down 26%, Gear for Music 32%, and Focusrite is 29%. Now I know when you look at these, you might think, oh, these are down crazy, it's really scary, but this doesn't really bother me. And I was kind of umming and ahhing whether I include this in the portfolio, because it's nice for you guys to see, but for me, it doesn't really matter. I would quite happily buy these and not look at them for a year or two. But yeah, that's a total. You can see here the potential upside still and how I'd recommend them. I'd recommend all of these as buys. I'm personally holding these for the time being, just because I don't know if I want to increase my exposure into the music industry. I think there's other industries I kind of want to broaden into first. But I would definitely consider them good options, and you can literally get these at a 30% discount of the price I've bought at. So for me, some of these just represent good buying opportunities. And all of the ones I've got here, I would still buy more of. I wouldn't be put off if you want to buy any of these, it's completely up to you. But of course, still do your own research. So in total, I've invested £6,000. I've not included the fees because I get charged fees. I don't know whether to include that or not. If you want me to, do let me know, but it's a bit more effort and more complicated. And really all I'm bothered about is how much money I put in and how much money I get back out. So the current is at 5,828. and I'm actually down 2.86%. But overall, I think I'm up 1% compared to the market, so I'm not too worried. It's actually quite good for me at the moment because when companies are down and I see good value, I can buy more. It's actually much harder to buy things when everything's up. And of course, I know if I would have done this last year, then it would have been so easy because you could buy pretty much everything and it was all on its way up. So yeah, that's how I'm doing so far. I'm going to keep buying, I'm going to invest more money and keep it consistent. I know some of you might look at this and think I haven't doubled my money overnight, but that's really not my goal and not something I'm bothered about. The plan is just to keep investing. This might take a year, it might take 2 years, but I'm going to get to that 100k. I think being realistic, my goal for this series is to do it within 1 to 2 years. But of course, it does depend on how well I do here on YouTube. If you haven't already, do take a second to smash that like button because it'll get this video out and hopefully generate some more money that I can invest in this series. As I said, the market is really rough at the moment. We'll just have to see where it goes, and I know a lot of you will probably be in the same boat, so just don't worry. And I think what's good about this, it shows that I'm just in the same boat as you guys. I'm not hiding behind my portfolio and saying that I'm making a fortune. I'm showing you exactly how it is. So I hope you found this useful and enjoyed this episode. Let me know if you've got any comments or suggestions on stocks down below, ones you'd like me to take a look at, because I'll consider adding those to this portfolio. And I've got some other videos right here you might find useful and enjoy watching. So thank you guys as always for the support, and I will see you over there.